Hey, what's up, guys? Riley Chase here with Hostify, and in this video, I want to talk about the question whether or not you should raise money for your startup. And this is something I talk to people a lot about, especially on Twitter. So, topics of discussion in this video, I'm going to talk about my own experience raising money for my business, when you should raise money, an example of the investment terms at Earnest Capital, why you might not want to raise money, how raising money helped me, and whether or not I'd raise money again in the future. Just kind of a disclaimer that I've been putting on my videos because these are just my opinions. It's based on my own experience. Every situation's different, and from my experience, I bootstrapped my a side project called Hostify. It's a micro SaaS business, and I built it from $0 to $2,000 in monthly recurring revenue with over 100 customers in the first 6 months. And then my initial investment, starting this was just $500 of my own money. I built the product myself, and I spent a few months on that. I ended up raising six figures from Earnest Capital in April 2019, and I used that money as a savings cushion to go full time on the business. A lot of people ask me like what I did with the money, if I hired someone right away or if I spent it on ads or something like that. I didn't do any of those things. I literally took the money, put it in my bank account as cash, and I left it there. And it just made me feel better and more secure that if something bad happened, everything was going to be fine because I still had that money. Flash forward from April 2019 to February 2021 when I'm making this video, we're now a team of five with 1,300 customers and $52,000 in monthly recurring revenue, and the business is very profitable, no plans to raise additional funding. So unlike a lot of venture-backed companies where they raise millions of dollars, they spend it all, and then they need to raise more money, and they keep raising and raising, and eventually, they finally find, become profitable, and they're $1 billion company, whatever. That's a very different path from what I'm doing. And this business that I have, it was always profitable from like the first month, and I didn't need to raise money, but it helped me, and I'll talk about why I raised money in a little while. A lot of people ask me when they should apply to Earnest Capital for funding. So, just a couple of quick tips. If you just have an idea, no product, no customers, no revenue, don't even bother looking for funding. In my opinion, especially applying to Earnest Capital, they're looking for at least some traction. It doesn't have to be like a big business or a lot of traction or a lot of money, but you need to have something launched, getting customers or users or money or something. And I don't know of anyone that invests in just ideas and stuff, really early stage stuff like that. Now this is kind of the sweet spot that I've seen, but this isn't, what you could get funding without this, or you could get funding way past this. But the sweet spot that I've seen, and this is where I raise money, is if you built a side project to a couple $1,000s in monthly recurring revenue, you got more than 50 customers, you're growing at 10% month over month, you have less than 5% monthly churn, then you're very likely to get funded. And feel free to DM me on Twitter, and I'm happy to help you, make an introduction for you. So included in this link here is my application, which I sent to Earnest Capital, Tiny Seed, NDVC, and Hustle Fund. I only received an offer from Earnest Capital, but I just want to talk about what was in my application. Now, when I first started making my application, I was really overthinking it, and I was going into a lot of detail about the market and the technical aspects and all this stuff. And luckily, I had a friend look at my application for me, who's knows what he's doing in the SaaS business. And Omar Khan at the SaaS Club podcast took a look at it. He said, just try to fit everything on one page and just answer these four questions really, concisely. The questions were, what problem are you trying to solve? How's your solution different than other solutions on the market? What traction do you have so far, and take a guess at the total addressable market size. And so that's what I did. And my only other advice here, other than keep it really concise, because investors are busy and they don't have time to dig into all the different aspects of the industry and technical details. Typically, the numbers, just let the numbers speak for themselves, and you're going to get funded or not based on your numbers. And one piece of advice I'd give here is just to not exaggerate what you're doing. Give a lot of numbers, and don't make statements like we doubled traffic last month, or customers are up this month by 80%. Like none of that. That kind of stuff is just exaggerating. It could mean that you're going from 100 visitors on your website to 200, and you did a 100% increase. And I see a lot of that stuff in investors they look right past all that bullshit and they get right to the numbers. So don't do stuff like that. And when you're small, don't be embarrassed about it. Just say, this is exactly where it's at. And if you're trying to exaggerate the numbers, you're not going to exaggerate your way into getting funded. You're just going to look like an untrustworthy person that they won't ever do business with. So just keep that in mind. Now, if you do get an offer, here's some of my advice on paying close attention to the terms of the offer. Some things that were really important to me when I was looking at, the investment paperwork and what the legal, definition of what this was I wanted to retain as much equity as possible. And one thing that was attractive to me about the Earnest Capital model was it's sort of like a loan where they're giving you a large investment amount. You owe them, 2 or 3x, 4x, or whatever the amount is. They want to pay back on the investment, but they're not getting a huge chunk of equity. So they start with 12% equity, and as you pay them back, they'll have as little as 4% equity by the time you've paid them back the amount of money they want to make. And so I'm able to retain ownership, and that's important to me. Another thing that was important to me was not having to discuss any business decision with an investor. So these are passive investors. They're along for the ride. They're not here to tell me what to do, or I don't have to check in with them if I'm going to make a big decision about changing pricing or doing something. They are just along for the ride, and they're not going to be giving input unless I ask for it, and I don't have to check in with them to make sure it's okay with them to do something. This was also another point that was really important to me was having the ability to pivot into an entirely new business using the investment money. And so the way that the thing that I was worried about was, let's say I get an investment for Hostify, and then a few months in or whenever I find out there's some fundamental flaw in the business plan, or I find some other opportunity that's going to be, possibly a much better idea, and I decide to start working on that as a side project. I want to have the ability to work on multiple side projects at a time, and then just go with the one that starts taking off. And Hostify was so early on, I didn't know that that was going to be the one that took off, and I was launching other projects. I had launched 2 other SaaS businesses and also a community. So I wanted to be able to continue to work on those as well. And this was something that was fine with the investors, and they said basically they're investing in the legal entity that encompasses all the things I do. And so they invested in Lachlan Networks, LLC in Michigan, and Hostify is doing business as, a DBA. And then I had, other business entities that were underneath that one entity that they invested in. And so that worked out just fine for both of us. Earnest Capital is really straightforward with their terms, and they're very transparent. And so you can actually look at, what their terms look like. I have a link here. One more piece of advice that I have is to hire your own lawyer. This is what I did. I paid a lawyer who I'd already worked with before. I paid her for a couple hours of her time. It was just a few $100s to look over the legal agreement and explain it to me as she read it. So I gave her the agreement. I didn't tell her my impression of it or what I thought it meant, and I had her tell me what it means. And so when she told me, this is exactly what it means, here's some things you should be aware of or should look out for, and I compared that with, obviously my understanding of it and what had been told to me by the investors. Everything checked out, so I knew that, what I see is, what I'm going to get, and I wasn't being, told one thing and then signing something else. So that was really important too. All right, so now I'm going to show you some example investment terms. These are not my terms. All terms are different, confidential, but this is a general framework that Earnest Capital uses in similar firms at this stage. So let's say you get an investment for $200,000. The investors want a 2x return cap, which means they want $400,000 out of it for you to pay back. And your founder earnings threshold, which I'll get to in a minute, is $100,000 per year. So you owe the investors $400,000. That's 2 times the amount they invested. They currently own 12% of your business, and you're going to pay back the investors the 400K if or when you take home more than 100K per year. That's the founder salary threshold. And so as you take home 100K per year, every dollar after that is going to be taxed at a percentage that goes back to the investors. So let's say you're paying them back 30% of every dollar after the first 100K, and so you take home 100 or you take home 200K, then you would owe them 30K. Then and once you pay them the 30K, then you only owe them 370K remaining. And once you do the math on that, their percentage of ownership went down from 12% to 11, then 10, 9, 8, and so their percentage is going down as you're paying back the money. Now, once you've paid back the full amount, you paid back the full $400,000, they'll actually only own 4% of the business. And once they only own 4% of the business, there's no more payments to be made after you paid the 400K off. But they still own that 4% forever, and they can liquidate that in the future if you sell the business or you raise more money, for example. So how is the funding paid out? This is something that I had no idea going into it. I was wondering, are they really going to trust me with this money, or are they going to send it to me in like monthly amounts or something like that? I didn't really ask about it, but I was kind of surprised that a few days after I signed the paperwork, it was like boom, the full six-figure amount was wired directly into my bank account, and I was free to do whatever I want with it. I didn't have to ask them any questions. If I wanted to pull it out and spend it on something, it didn't even have to be on the business. It didn't really matter. It was my money. All right, so now I'm going to talk about the biggest question you need to think about before you accept funding or before you go looking for funding. And that is, how big of a business can you or do you want to build? So I want to give an example to kind of demonstrate this point. Before taking on the funding amount using this example, so let's say I raised $200,000 from Earnest Capital and I owe them $400,000. I could have built Hostify to just $100,000 in annual recurring revenue, which, by the way, I got there in just a little over a year in business. So a year later, I had built Hostify to $100,000, and I could have then sold it. Typically these type of businesses sell for about 4x, and I could have sold it for, let's say I sold it for $400,000. That would have been a great financial win for me personally. $400,000 that I earned in just 1 year of work. But with the funding, a $400,000 sale wouldn't even really be an option for me anymore because 100% of the proceeds would have gone to the investors. Now, on the other hand, if I build Hostify to $1 million ARR and I sell it for four, investors get 480,000 because they have 12% ownership at this point, and that would exceed their $400,000 market cap. The ownership would be greater than the market cap. But anyways, if I sold it for $4 million, I would get $3.5 million, and it's not as bad of a deal. They might have helped me in a lot of ways, and the difference between $3.5 million and four isn't that big, but the difference between $400,000 and zero is really big. So the point is, if you think you're going to be able to build a business in a market where you might be able to build $100,000 per year business, that might be great for you personally. But as soon as you bring on an investor, that could make it a very bad business. And so, if when I took on this funding, I knew I had to build a bigger business, and it needed to be $1 million business, not $100,000 per year business, or else it wasn't worth taking the investment money. So when you take funding, you're giving up what could have been a small win, and you're committing to sticking with it for a bigger win. Now, I think this is an interesting psychological hack. So by taking on funding, I committed myself to that big win. One of the reasons that I took the funding was to force myself to commit to this. And after I had built the business to $100,000 in ARR in a little over a year, that could have been tempting for me to sell it for $400,000. That would have been the most amount of money that I'd ever seen in my life. But I knew that $400,000 wasn't going to be a life-changing amount of money in the same way that $4 million would be. Taking funding was one way to force myself to commit to this bigger goal that I had of building $1 million business instead of building a $100,000 business and sticking with it. So in this slide, I'm going to talk about some of the ways that raising money helped me. Like I said, I didn't have to raise money. The business was profitable from day one, and I never needed the money. But there are a number of reasons that I took the money anyways. And in this order, and first, and I would say this is the most important reason is it de-risks the opportunity cost of going full time. So if I kind of talk more about opportunity cost, what that means is I was taking a big risk in my career. I had finally built up my career where I had a degree in IT security. I had just gotten my first job as a security analyst. I was making $100,000 per year. And now here I was going full time on a side project, making $2,000 per month. I didn't know if it was going to turn out and become a good business or not. And not only was I going to lose money if I hadn't taken the investment, I was going to lose money that I could have made that year. But I was also putting my career at risk, where if I had a failed business, there was no guarantee that I'd be able to, go back to working as a security analyst with a gap on my resume of a year or 2 years. No, by taking the investment money, I had money in the bank. I didn't have to worry about that. And even if the business didn't work out, I had still at least paid myself, and I could keep the investment money, and that was equivalent to, a couple of years of pay. Like I said earlier, taking the money made me commit to the big win. And so by taking this money, I was taking away the option for me to find the easy way out and sell it for a couple $100,000. And I was committed to building a bigger business with a bigger impact. Now, I also have an incredible mentorship team um, from successful business owners who all have skin in the game. So all the mentors that help me, they take the time and spend time with me. Partly because they're really nice people, but one of the problems with mentors is they're very busy people. And so, what's different about Earnest Capital that I really like is that all the mentors have skin in the game. They're all investors in my business, and so it makes them a little more incentivized to take time out of their day to help me, and they've all been very helpful. One of my favorite parts, other than mentorship, is the community of like-minded founders in the portfolio. So there's a bunch of people just like me that, they're committed to building their businesses, and we're all trying to build similar businesses in many ways. So we've been able to help each other a lot with, what we're going through, just, mentally, from different points of view, like, the tools we're using, and different things that we're learning along the way. In addition to, the mentors and the community of founders, I've also met a lot of people in the SaaS industry. So now, because I've been part of Earnest Capital, I've met people who buy SaaS businesses. I've met accountants. I've met other investors and other founders. And now I have a little bit of a credibility boost on my resume, having raised money before. It's probably going to be easier if I want to raise money again in the future, and customers can see that, there's a investment firm behind this business that is committed to seeing that it's successful as well, outside of just myself. And so, the reason I said in this order is because I don't want to overemphasize the mentorship in particular. Now, the mentorship has been amazing, and it's one of the main reasons that I took the investment money. But a lot of people think that mentorship is like it is on Shark Tank. Like, none of my mentors like called up QVC and got me a spot, or called up Walmart and got my product in every store or something like that. Mentorship, the mentors are not taking my business to the next level and finding me customers and doing all the work for me. They're really just there for me to bounce ideas off of. And my mentors are really nice people, and they've built successful businesses. They're super knowledgeable, and they all like take the time to talk with me, which I'm super grateful for. But in general, when I talk to mentors, it's more like, here's what I'm going through, and then they share like their story, like, here's how I handled that. This doesn't necessarily apply to your situation because every situation is different. And that's one thing that I really admire too, is that they don't tell me like, hey, you're doing that wrong, this is exactly how you should do it, and do these things and come back to me when you've done that. It's nothing like that, where they're like, the QB, and they're just, telling me, how to make the next play or whatever. It's more like, a friendship, and here's how I handled it kind of thing. All right, so I want to talk about whether I'd raise money or not again, and I think a lot of people ask me this, like, would you do it again? Because knowing what I know now, my business really took off after I raised the money, and perhaps if I hadn't raised money, my business still would have took off. And so there's this idea that if the business fails, then it's a good thing for the founder. I mean, it's not a good thing, but it's like a good thing that like they took the money, at least they took some chips off the table. But if the business succeeds, then the founder has to pay the money back, and stuff like that. And so I don't feel bad at all about having to pay the money back, and I think it's a great thing. And in the future, I would raise money again. I would raise money if I could go back and do it again. I would raise money again for Hostify, and if I start another business in the future, I'd probably still raise money. Even though now my situation is very different. If I were to start another business today, I have connections, I have mentors, I have my own money. But the reason I'd still start a business, I'd still raise money if I start a new business today, is de-risking it. So yes, I could put all my own money on the line and spend years working on something, and it might not work out. But I could share a little bit of that with the investors, and they could take on that risk. And so they give me money to kind of get started and invest in the business. And so I'm not risking all my own money. I think that, that's a big reason why I would raise money again in the future. And so by starting with this small investment that I've taken from Earnest Capital and paying it back, I'll have some credibility in the fundraising world. And so more than likely, if I start another company, it's going to be even easier for me to get access to more capital if I need it. Like I said, de-risking would be more important than the mentorship, the community, and the connections at that point because I already have a lot of those connections. But de-risking would be the main reason I would raise money again in the future. I hope that helps. And these are just my own opinions based on my own experience, very specific experience of building a small micro SaaS business. And, it's very different from other businesses that people might need to raise money for and stuff like that. Every business and investment situation is different. I'm not a lawyer. And feel free to DM me on Twitter if you have questions about any of this stuff. I love to discuss these topics. And my username is @_rchase_. Thanks.